Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Anthony Woodside, head of U.S. fixed income at LGIM America, to discuss hidden landmines that await beyond the debt ceiling. Anthony, it is great to see you again. Welcome back to TradeTalks.
Great to be on the show as always, Jill. Thank you.
You got it. And now with the debt ceiling more or less resolved, some market participants have subscribed to the oversimplified narrative that the coast is clear for risky assets. Do you think they might be thinking ahead too fast?
Yeah, we would say not too fast on that. We have our reservations here, and they're really predicated on a few things. One is if you look at economic momentum, it's really waned in recent quarters. And secondly, when you look at the contours of this deal, there's going to be limits on federal spending here, and we think that's going to provide an additional headwind for growth. But perhaps, Jill, what has not received enough attention is the fact that there's going to be an impending liquidity drain on the market. So perhaps let me provide a little context because I think it's going to have very important ramifications for asset valuation. So the Treasury, because of the borrowing capacity limits that they've been running down their T-bill balance. So they've basically, T-bill issuance has collapsed, and their cash balance at the Fed, their Treasury general account, has really shrunk to very low levels here. Now, with the stalemate basically in the rearview mirror, you're going to see a wave of supply for T-bills flood the markets. When T-bill issuance collapsed, that actually bolstered liquidity temporarily. Now you're going to see that reverse. And the question is, who's going to be the ultimate buyer of that debt? We do think that that's going to have a very important set of consequences for asset valuations here.
And then also, let's talk about what's happening with the banking system, right? I mean, we know that the Fed took up rates really fast in a small amount of time, and that velocity of rate hikes was tough for many of these banks to manage. Now you're starting to see accelerated deposits flee the banking system in favor of money markets or other instruments that are paying higher than 0.01%, 0.02%. We know Apple's now offering 4.15% on the yield. American Express Savings is somewhere around 4%. You can't blame depositors for looking to move their money, but what does this steady outflow mean for the banking system?
Yeah, so we do think that the Fed monetary policy settings has provided a big challenge here, and in some cases exacerbated what we're seeing in the banking sector. So you actually hit the nail on the head here. So when you look at the hiking cycle from the Fed, so Fed hikes, fastest hiking cycle that we've seen in 40 years. When you look at the policy rate here, the policy rate is at 5.25%. The highest since the pre-financial crisis period. And what that has done, as you pointed out, has led to deposit flight, and money market funds have been the primary beneficiary of this. So what money market funds can do is they can take that cash, deposit it at the Fed through the reverse repo facility, and they can earn an attractive reverse repo rate, which closely tracks the Fed funds rate and is significantly above what banks pay on deposits here. Now, also in the background, what you're seeing is that the asset side of the balance sheet, the Fed is engaged in quantitative tightening. So that reduces the asset side of the balance sheet, and liabilities must shrink in commensurate fashion here. So what are the primary liabilities at the Fed? You have the TGA account balance that I was talking about. You have the reverse repo facility, and then you have bank reserves as well. So we already know that the Treasury is set to build up its TGA balance, so that's going to rise sharply. So the brunt of the decline in liabilities is going to come from either reserves falling, the reverse repo facility falling, or some combination of the two. Now, what's going to be the ultimate determinant of which liability shrinks is going to be determined by who's the ultimate buyer of the debt. So if households buy the debt, then what you're going to see is that deposits and bank reserves are going to shrink from the system. And we think that's the most punitive outcome here. When you look at equity total returns, when you look at excess returns in credit, these are positively correlated with the change in reserves in the last 10 years. So if reserves fall, the market resilience, the resilience we've seen in both of these markets is likely to be tested in the coming quarters. Conversely, if money market funds decide to rotate out of the RRP and into T-bills, that's going to be the most benign outcome on liquidity here. However, we would say we don't think that that's going to be the most likely outcome, just because there's still some uncertainty around the Fed hiking cycle, and RRP rates are still above T-bill rates, so T-bill rates will need to rise for that to happen.
So how do you think about fixed income positioning with this type of backdrop?
Yeah, so Jill, I would say that when you look at the resolution here, of course, that was the better than the alternative, right? No one wanted to see the US government default. However, we do think that there is considerable risk that lie beyond the debt ceiling here. So when we look at the landscape right now, we think that the risks are firmly skewed to the downside here. We think that the Fed is still struggling as they're trying to manage this delicate balance between price stability on one hand and financial stability on the other hand. Consequently, given the backup that we've seen in rates, we have turned constructive on the long end of the curve. So we like the 30-year part of the yield curve. And then secondly, we've tried to maintain a higher quality portfolio with ample liquidity because we do think that there's going to be better opportunities to reload on risk as volatility really takes hold in the coming quarters.
All right, Anthony, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks again, Joe.